If you've been watching my channel since I started it about 2 months ago, you will know that I love gaps. I love any type of gaps in the market, whether that's a fair value gap, a new week opening gap, or a new day opening gap, or an opening range gap. And that's the gap we're going to talk about today. This gap is kind of hidden from you because if you don't know where to look for it, then you're not even going to be aware of it. So today I'm going to show you exactly what an opening range gap is and how you can use it in your trading. So on TradingView, we have two types of charts that we can toggle. We can toggle the electronic trading hours here, or if we scroll down to the regular trading hours and we toggle that, then you will see that we get these gaps formed. Now, the only difference between these two charts is that the electronic trading hours is going to show you all the movements in price 24/7 essentially, apart from the 1 hour that the market is completely short between 5 p.m. and 6 p.m. Other than that, the market is open the rest of the time and is moving around, and you can see that on electronic trading hours. But if we toggle regular trading hours, you can see that this candle here stops at 4:15. It says 4:10, but it's a 5-minute candle. So the market closes at 4:15 and then it reopens at 9:30. Now, the gap that is in between this closing price and this opening price is what we call the opening range gap. Now, you can do this on any time frame chart. I just do it on a 1-minute chart so I can see exactly where that candle closed and then where it opens for the next day. So we want to take our fib and we want to measure from where it closed, and this is important, where this on a 1-minute chart, where this 4:14 candle closed, not where its high is, not where its highest point of the body is, because sometimes that might be the open if it's a bearish candle, where it closed. So this is a bearish candle, so where it closed is there. And then I drag it up and I extend it up to where the 9:30 candle opened. So close to open, very simple. And then we want to anchor our fib to those two levels, and then we can measure the 25% of that range, the 50% of that range, and the lower 75% of that range. These levels are all going to be used for that day's trading. The levels I will note is the open, the close, and the midpoint or consequent encroachment. You can use the 25% and the 75% or upper quadrant and lower quadrant. I just don't tend to. I just find that it clutters up the chart a bit, so I don't tend to actually note them because most of the time I'm paying attention to the midpoint. But if we have a very large opening range gap, then I will toggle these other quadrant levels. But that's just me. You don't have to do it exactly how I do it, obviously. Now, there's a few things to note about an opening range gap, and one is how large that opening range gap is. So in the 2025 lecture series, ICT gave some very strict rules for how an opening range gap is going to be used, depending on how big the opening range gap is. So I'm going to share those rules with you now. Okay, so first rule is if the opening range gap is 120 points or more, then the gap can remain unfilled. That means that it doesn't fully close in the gap. It can leave it partially open. If we have an extreme gap, so about 150, 200 points, mainly 200 points is what I'll use for this. If it's 200 points or more, then it is likely to just keep moving in the direction of that gap. So if we have gapped up overnight, and if we've gapped up over 200 points, then we are likely not to retrace into that gap at all, or very little. And we are likely just to keep moving in the direction of that opening range gap. So these are all little things that you can use based off how the opening range gap is formed overnight to give you a little bit of a narrative going into the morning session. Another nice little rule for this extreme gap that ICT taught in that video was that if we do retrace into that opening range gap, then we can target the 25% of that opening range gap, or the first quadrant that we come to in that opening range gap. And then he also taught another setup for if it's a 20 to 75 point opening range gap. A nice setup can be to look for some pre-market liquidity, so London liquidity or just pre-market New York session. So anything from 2 a.m. to 5 a.m. or 5 a.m. to about 9:30 a.m. Anything before that opening range gap has formed and the market has opened, we gap up, and then overnight when the market was closed, we made some pre-market buy side. So we open here, run up, sweep that buy side out, which obviously isn't viewable on the regular trading hours chart. That's when we go back to the electronic trading hours chart. So it's all about switching between these two charts and using the information available in both of the charts. So we run up, sweep that buy side, and then we can look for a short into the opening range gap to fill either the midpoint, as would be your first target, or if the market structure is exceedingly bearish, you could even look for a full gap fill, so targeting the low of the opening range gap in this case. Then all you do for a long for this model would just flip it upside down. This could be your model. This could be your complete model. You only look for this and you look for nothing else, and that's a very easy to follow, simple model. But I mean, it depends how many times we're going to get an opening range gap of 20 to 75 points. How patient are you going to be with that? Are you going to wait for that opening range gap, or are you going to be tempted when it's a bit of a larger opening range gap? Maybe it's 90 points and you still want to try it, and then you lose, and then you revenge trade. People don't want to follow what's simple all the time. Even though they want what's simple, they don't end up actually following it. It's kind of pretty funny when you look at it that way. And then the final rule or guideline, none of these are hard rules. They are kind of just guidelines, obviously. It's better to have that in trading rather than a specific rule. It's more just a guideline that you can follow, and with experience, you'll learn when to break that rule and when to follow it. But the final kind of guideline is 75 to 100 points opening range gap. That's when it can go either direction. It could just run off, or it could come back and fill part of that gap or fill the whole gap. That's when you have to lean more on the other things like market structure, if you've seen the previous video that I did, and other things like your daily bias, your daily narrative, where the liquidity in the market is, where are the imbalances, what is it reaching for in that day. That's when you want to be leaning on all of that stuff to then get an idea of if it's going to fill that opening range gap or not. But moving on to the final point, the final thing you can do with the opening range gap, if you want to go really in depth with it, is you can plot them throughout the entire week. In fact, what I'd recommend doing if you're going to do this is have a complete separate chart, a complete separate template that has the opening range gaps that are in close proximity to price if you want to go really in depth with this. I don't tend to do this just because, obviously, as you can see, I've only plotted 3 opening range gaps on here, and it's already starting to really fill up the screen. So you can imagine how cluttered up it would make your chart if you had these as well as all your other things on the chart. But it is definitely cool to see how these opening range gaps are used. As you can see, we gapped down on Tuesday and didn't fill that gap in at all. We just ran away. And then the next day on Wednesday, we came up, ran up into the lower quadrant of that opening range gap, rejected. Where did we come back down to? The opening range gap that was formed for Wednesday's trading and the upper quadrant of that. Then we ran up, rebalanced all of this opening range gap, and then came back down to the midpoint of it. And then we opened down here. Where did this run go down to? It went down to the midpoint of this opening range gap, and then ran up and rebalanced its opening range gap. So you can see how in depth you can go with this if you want to. That's all optional. Personally, I don't. I focus mainly on what the opening range gap for that day is. I will sometimes note a gap like this. If we have a gap that's just not been filled in at all, then I will look for it to be filled later in that week or the next day. That is one time I will extend the opening range gap further than the day that it was formed. But that's how I use the opening range gap in my trading, and I've given you all the rules that I know and use in my trading. So I hope you learned something, and if you want to give the opening range gap a try, then I would recommend it because it does help give you that added narrative for a specific day and possibly even for later parts of the same week. But that's all from me in this video. If you're trading today, tomorrow, or next week, then I will wish you good luck, good trading. Catch you later, boys.